Okay, so is the volume up? Hello, good morning. Can they hear me?
Yes, sir, we can hear you.
Good morning.
Okay, good morning.
Good morning.
And welcome to... Good morning and welcome to our second webinar for 2024. After this, hopefully, we would have 2 more to go. The last one in November, we'll be looking at how we can prepare as business people for 2025 and beyond. But for this morning, our emphasis will be on unlocking the conditions for growth in your business, unlocking the conditions for growth in your business. We have to make use of the chat boxes, the chat box. So when you have a question or you have a comment, you can put it in the chat box. Alternatively, as we move along, I will pause, ask a few questions, and then you can raise your hand. I will see, and then I would ask you to ask your question. It's going to be interesting over the next hour and a half. I'm hoping that participants will also share their ideas, share their thoughts as we move along. So first of all, let me check if we can all see my screen. If you can all see my screen with my traditional bow tie, always present. You can see the screen, right? Okay. All right. So the first question, I want to ask a few questions. Maybe the first one simple question I will ask is why you think growth matters? Why do you think growth matters? Why should businesses be focused on growing? Why is growth such a big conversation that we need to have it this afternoon? You can put your thoughts in the chat box, and as I move along, we'll read a few of your thoughts and a few of your contributions on why you think growth matters. But let me start by giving you some genesis of what is happening across the globe. And let me say that global business outlook is looking very positive. There is a rebound across all sectors of the global business world. So all sectors have recovered. The airline industry has recovered. The hospitality industry has recovered. Supply chain is almost close to recovering, but we are almost there. Trade is progressing well. The big economies have seen a rebound in their economies. GDPs seem to be moving up. So we can conclude and say that the global business outlook is very positive, and businesses across the world have truly recovered. In the last 3 years, we have seen a massive growth in global wealth. And global wealth in the last 3 years, 3 to 5 years, has increased by about 40 trillion, 40 trillion. Now, that is massive growth in the last 3 years or so. And the post-COVID era has been amazing for most billionaires and most millionaires across the world. Now, my research shows that 21 organizations have 21 of all the organizations in the world, 21 big organizations have obtained or gathered a disproportionate 43% of global growth in the last 3 years. That is huge. And as we go along, I'll also indicate to you that of the 21 organizations that are leading in perhaps the growth agenda, close to 15 of them are in the tech space, are doing something that is tech related. So technology is huge if you are to move up the growth curve. We've also seen that the top 10 billionaires collectively since the days of COVID amassed an average of 50 million each hour. The top 10 billionaires since COVID, since 2021, 2022 to date, have amassed the equivalent of 50 million US dollars every hour in the last 3 years. So the top 10 billionaires amass a close to $150 million every hour. The question I ask is, how much is your organization or your company amassing each hour, each day, or each month? We'll talk about it. And also to put in context that the top 1% of people in the world, there are about 7.2 billion people across the globe. And the top 1% of them own and control 46% of all global assets and resources. So just about 70,000 or so people, 700,000 people control 46% of all global resources and assets in the world, and we should be guided by that. One other information that I want to share before I go to the conversation is 7 in 10 CEOs who are either currently CEOs or founders of the 21 top organizations I talked about is a billionaire, 7 in 10. So of the 21 organizations, close to 14 of them have their CEOs and their founders being billionaires. Why is that? That is because they are at the leading edge of driving growth. So growth is very, very important. And in the last 3 to 4 years, global GDP has grown 17%, increasing from about 86 trillion 4 years ago to now more than 100 trillion. Of course, the United States of America has a 25% share of global GDP, followed by China, that has an 18% share of global GDP. So between China and the United States of America, the two of them control 43% of the 100 trillion, 43% of the 100 trillion. So as a businessman operating in sub-Saharan Africa, the question is, where is your growth going to come from? And which country or which economies should you drop closer in order to tap into the wealth that they have? And obviously, it is the United States of America and China. And since doing business in America is a bit more difficult in terms of your capacity to attract and retain, the obvious place to be is to partner with businesses that are in China, because that's where growth is going to come from. So I've been asking myself a number of questions, having looked at what has been happening globally, locally, and across the African continent. I asked myself a few questions. One of the first questions I asked myself is, why are the top 21 organizations delivering double-digit growth consistently? In the last 3 to 5 years, my research has indicated that I have researched over 109 companies globally. And the top 21 organizations on the 109 list deliver double-digit growth consistently each year, both in top line, in bottom line, and in earnings to investors and shareholders. Why are they doing that consistently? What do they do? What are the things that they do on a daily basis that is driving their growth level and consistency? Why are the top 1% doubling their wealth every 3 years? Every 3 years, we've seen the wealth of the 1% controlling global resources double their wealth. The question is, why are they able to double their wealth every 3 years? Every 3 years, and they have some answers to share. Why are some organizations in progressively forward-looking industries or sectors collapsing? So we've seen entities collapsing. So it is not only entities that are growing, but they are also entities that seem to be collapsing. And we want to talk about why these entities are collapsing. So in the course of the conversation, we'll talk about that. And I asked myself another question: why have over 5 billion people in the last 4 years, 5 billion people have fallen into poverty? And many organizations are presently stagnant and are in decline. Why is that so? The top 21 organizations are delivering double-digit growth consistently. But on the other hand, we have some organizations that are also stagnant and that are in decline. We have to ask ourselves why. Why is that so? And we have some answers to share. And the next question I've asked in my research is, why is growth elusive for some organizations and in some markets? Why are some markets not growing and some other markets flourishing? Why are some organizations not able to deliver growth and some other organizations delivering growth consistently? I have an answer to that. And I've also asked myself, what separates a growing organization from a stagnated and declining one? What do they do? What are the habits of organizations that consistently see growth that's making them grow? And what are the habits and the behaviors of organizations that are not seeing growth? Is there a difference? Do they do different things? Do they approach things differently? Do they have a different way of bringing people into the organization? Is their recruitment processes same or they are different? We'll look at that in the course of the organization. And then the last but one question is, how does an organization set itself up for growth? How do you build the pillars to enable your organization to grow, with or without the founder and what we call the anchor CEO? How do you do that? And then finally, what actions and habits put an organization on a path of consistent and sustainable growth? So growing is one thing, but consistently delivering on growth that we will define as sustainable. And I'll define what is sustainable in the course of the conversation. What is sustainable is also another matter. So growing is one thing, growing sustainably is another thing, and growing consistently and in a sustainable way is also another thing. So I've been asking myself these questions. And what have I been doing? I have researched 109 organizations, 109 organizations globally, to get some answers to some of these questions and to be able to share with you in 90 minutes. So what I have done in almost 2 years is what I am sharing a small part of it with you in 90 minutes. 109 organizations have I researched, 67 local and African. So of the 109 organizations that I've looked at, 67 are in Ghana and some across Africa. The rest are all foreign, outside the African continent. I have also studied 53 CEOs, 56, 53 global CEOs. I've looked at the things that they've been doing to grow their businesses. I've looked at their habits and their behaviors that resulted in their businesses declining, and some of them exiting, and some of them filing for bankruptcy and being liquidated. I've looked at that. And I've done a 5-year trend analysis of 78 financial statements. So there are 78 organizations that have taken the pains to look at their financial statement over a period of 5 years in order to build a trend that then confirms some of the things that I've learned looking at the 109 organizations as to why they are growing and why others are not growing. So what I'm sharing with you is a 2-year research that I've been doing, and I'm sharing just a small part, as I said, with you as I work on a book that may probably be published next year. So I've done almost 2 years of research to come to this point. And what I'm sharing with you is each thing that I take runs through a number of companies, confirmed, affirmed, checked, rechecked, to be sure that it's really worked in the organizations. So in doing this, 109 organizations, 67 local, 53 CEOs, 5-year trend of 78 financial statement organizations, almost 2 years of research. What are the 7 things that jumped at me? 7 things that jumped at me. And I call them the running themes that are common across organizations that have grown and that are common across organizations that have died for not doing it. One of the things that I've realized is that growth is deliberate. Growth is deliberate. So checking across the 108, 109 institutions, some have grown, some have stagnated, some have declined, some have died. One of the things that the conclusions that I've reached is that growth is deliberate. It's a deliberate process, deliberate intent by an organization to say, we want to grow, we want to be big, we want to be dominant, we want to be influential. And as I get to the 7 steps, and there are 21 things, but I'm going to share just seven of them with you today to unlock growth. Number 2 is I found out that the growth is a marathon. It is never a sprint. It's a marathon. So it's a long process. It can be painful. It requires a bit of patience. The organization must know where they are going. They must know that they have to cross some rivers. They have to climb some mountains. They have to be able to navigate some very difficult forests to get to where they want to get to. So it's a marathon. It's never a sprint. I was telling somebody this morning that growth is not a tournament. So if you look at the tournament, like a football tournament, the Euros just ended. The Italians, who were the champions of the last Euro, were booted out. If you look at the World Cup is a tournament. And because it's a tournament, it is rare for a country to defend a World Cup, to defend, win and defend. So if you go through history from then when the World Cup was started, no country, just 2 or 3 countries, maybe 2, have been able to win and defend. In the Euros, maybe only 1 country has been able to win and defend. African Cup of Nations, it is difficult for a country to win and defend because it's a tournament. Okay, so the results and the outcomes of tournament does not indicate growth. Does not indicate growth, because growth is a marathon. It is never a sprint. So if you have one big breakthrough and you have one big revenue coming through, that comes to drive your revenue up, improves your profit, and gives you cash flow, and you are not able to sustain it, that will not be categorized as growth. Okay, that's the second thing that I found. The third thing that runs across all the organizations I looked at is that there are no quick wins. There are no quick wins. If an organization is focused on growing, you must know that there will never be quick wins. It is painful, it is a slow process, but that is the way it's supposed to be. Number 4, I already mentioned that it's painful, it is a long process. Even getting the growth agenda right sometimes is problematic. How do we get the growth agenda right? How do we get the right people in who have a growth mentality? How do we change the culture of our organization for our people to think growth? What are the things that we have to do? It's a long process to get it right. And I also realized number 5 is that growth is as a result of right and consistent habits. The right and consistent habits. So you can have consistent habits, but they may not be right. You can have the right habits in the organization, but they may not be consistent. Across the 109 organizations that I have painfully stated and researched, I realized that for those that are at the top of the group, the growth curve, they do what is right and they do it consistently. And we also realize that one of the things is that to grow, you sometimes have to take risk. Risk is a critical enabler of growth. No risk, no growth. If you want to grow, you have to take risks. And dealing with the 7 keys to unlock growth in your organization, I'll talk about some leadership attributes that is needed to drive growth. And finally, the big one that cuts across the 21 organizations that control almost a third of all growth globally, is that they use advanced intelligence. I didn't say artificial intelligence. They use advanced intelligence that is driven by technology. So most organizations have invested a huge amount of money in bringing technology into their business. The question that I ask is, that technology that you've brought into your business, what is it doing to you? Technology must only do 3 things. If you bring technology into your organization, 3 things must happen. Number 1, technology must facilitate and must be an enabler of decisions. So you should be able to make decisions quicker, faster, etc., because you have technology, because it's giving you data and you are using the data to make decisions. So one reason why technology separates one entity from another is how they are using technology, or how they are using advanced digital platforms or whatever they introduce into their business to make decisions. Number 2, technology must drive revenues. It must unlock revenue streams. It must show you paths that can lead to the end that you are looking for. And then number 3, technology must improve your business significantly in terms of efficiency, in terms of productivity. Technology must lower your costs. I mean, if you invest 1 million Ghana cedis in your business, in technology, and the cost of doing business is the same, then technology is not being used the right way. And when I talk about reducing costs, I'm not talking about costs in the fixed arena, costs in the general marketing and administrative arena. I'm talking about cost of delivering a service to a consumer. If we are delivering a service to a consumer at 10 cedis, because of technology, you should be able to deliver the same service much better to the consumer at a cost of less than 10 cedis, because we have introduced technology. It's giving us advanced intelligence that enables us to serve the customer and the consumer better. So these are running teams across organizations that have shown growth, as I studied them over a period of time. But I also noticed that the organizations themselves do 4 very important things. Okay, they do 4 very important things. One of the things that organizations that are at the forefront of growth is that they are in the business of refining their business model almost consistently in anticipation of changes. So the business model that they use to run their business changes. It changes in a way that puts them in a state to be ready for any changes that the market will throw at them. And in doing that, I also realized that they don't have departmental silos, etc. So the whole organization is a whole. So there's what we call coherent preparation that takes place. So if you read some of the strategy documents, and I've read many strategy documents, some huge, some are very different, and that are delivering consistent growth. One of the things I see is coherent preparation that shows up. There are some messages in the chat. So I want to be able to read them as we move along. Then the second thing I also realized running through them is that there is coherent focus on strategy and long-term objectives with minimal emphasis on short-term results. So these are organizations that discuss strategy, the KPIs around strategy, the indicators around strategy, and all of that. They are long-term in thinking. So they are not too focused on the short term. They are very focused on the long term, not short term. The third thing I realized, I've talked about it, is that there's coherent application of technology. And they use that to modernize processes, products, operations, and for competitive edge. That is why they are bringing technology into the business. So to these companies that are at the very top of gaining a disproportionate share of growth, technology is to enable them deliver better products to customers. Technology is supposed to improve their processes so that the cost of delivering the product or the service to the customer reduces. They bring in technology to improve their operations, and they introduce technology so that they can be one step ahead of competition. And I'll talk about the timing. When do you have to introduce technology into your business? And then they have a coherent prioritization of 5 essentials. Everyone in the organization talks about 5 things. Number 1, they talk about cash. In these organizations that I've studied that are at the forefront, cash is the critical element in the business. Experience is the customer getting from our product or from our service. So if you look at the Emirates adverts on CNN, the Emirates adverts on CNN talks about experience, customer experience. That's what they talk about. Because as for the product, everyone can deliver the product. But what sort of experience do you have by coming into contact with our product and our service? So they talk about customer experience. They are focused on profitability. They know that to be able to generate the cash and to repeat the experience for the customer, that customer must be profitable. So they don't look at profitability as a whole. They look at profitability from a customer point of view. Which consumer is profitable? Which consumer is giving us the most profit? Which consumer is delivering us the most cash? Which consumer is giving us more money, but it takes less efforts to serve? That is what their focus on profitability is. Their focus on profitability is not that we have made 10,000 in revenue and we made profit of 5,000, so we have a 50% operating margin. No. In the 10,000, they want to understand. That is why they use technology. In the 10,000, they want to understand who is giving us the money, who is a big customer for us. That is why Emirates, Etihad, and Singapore Airlines are the 3 biggest customers for Airbus and Boeing, because they give them the most in terms of profitability and in terms of cash. The 4th thing they talk about is digital transformation and advanced technology. Digital transformation and advanced technology. How do we transform the way we do business? Using technology and digital platforms as an enabler. They talk about that. And then finally, they discuss talents. Where is the next big guy going to come from? Where do we get them? And remember, these guys, one of the things that I realized, reading through most of the CEOs that I studied, is that most of these CEOs were brought in, some as rookies, some as interns, some directly from school. So they went through a process, not from somewhere, but there are people that they brought in and put in them their own DNA. So where is the talent going to come from? And they target particular institutions and try and grab the next big talent from those institutions. That is what the growth stars, I call them the growth stars, That is the 4 things that the growth stars do. And I want to go to the comments and see what's in the comments. Let's get some comments. I don't know if there are questions there. Okay. All right. Okay. Graph that I was trying to put up myself. And I'm giving you an idea of how technology evolves, And there are 4 main pillars within the technology space, from when it is created to when it hands over to another technology. And I've realized that there are 4 main categories of users. We have the group that we call the innovators. So they are at the forefront of designing the next big thing. Okay. So Microsoft is a big innovator. Airbus is a big innovator. Boeing is a big innovator. How do we get things better and done well? These are people who are looking at the next big thing. So Marriott is an innovator. How do we introduce technology into our hotels system that makes us better? Then there's a second group we call the early adopters. These are people who are waiting for people to innovate things, and then they'll bounce on it immediately. So this group of people, we call them the early adopters. What I've realized is that of the 109 entities that I studied, the 21 who are mainly controlling 43% of all growth across the globe fall into these 2 categories. They are either innovators themselves or they are early adopters themselves. And then that makes up 15% of the number. Then a whole lot of us who are in the majority constitute 70%. So there are organizations that wait for early adopters to adopt it. And when everything is fine and people think that it's matured, then we go for it. So there are organizations who don't want to try. They want to go for matured products. 70% of organizations are in that space. And then there's another group we call the slow adopters. The slow adopters are adopting it when everybody has adopted it already. And so it becomes like a mass product, something everyone has, so we should also have, but the people who lead and the organizations that lead are in the first 2. They are either innovators themselves or they are the group that we call early adopters. So this is just to set the tone for the conversation. I'm going to move on to introduce the topic, and I will mention some few companies as I begin to do that. So I have seen companies that have sprung up. I call them from startup to sustainability. And all of you, or most of you, know the company called Jumia. I'm sure you all know Jumia. So the case of Jumia is one entity I've studied. I call their move up and their slow landing as a roller coaster acceleration. So I mentioned some few companies, and for those who need the data, these are all companies that I have studied. So Jumia, from startup to sustainability. Then we have businesses that we call from my business to the business. I call them from my business to the business. So they start as my business, CEO, founder, manage, and over time, their strategy and a constant execution move them into another space. And I'm using the case of Multimedia Ghana Limited, which was Kwesi's business, now to a business that goes beyond Kwesi Chum. And for the ladies who are into the cosmetic space, I'm sure you know Mary Kay. She's dead and gone, but the business is still alive. So Mary Kay and the husband started it as from our business, and in the course of trying to start up the business, the husband died, the son took over, gave the mother some $5,000 to continue from where the father had left off. And today, that's the Mary Kay that you see. So this is a company that I call had developed both Multimedia Ghana Limited and Mary Kay using what we call focus strategy and consistent execution. Very focused. They knew what they have to do over a 5-year period, like in the case of Multimedia Ghana Limited, Group Limited, and in the case of Mary Kay, what I call consistent execution got them to that point. Then we have a third group that I categorize as from passion to public business. And you all know the story of Facebook. I mean, Facebook students trying to build a student platform. Similar thing had happened in Ghana. Multimedia Group started some platform they call mypadis.com. Mypadis.com was started by Multimedia way before Facebook got to mass market, but they were not able to move it to mass market. Now you know that is one of the most valued entities in the world. So that is from passion, something that we are doing to 1 million in revenue, not to talk about in excess of 3 billion of revenue. So I call that from passion to public business. And I'm using the case of now Meta, Facebook, where demand and acquisitions, Facebook's strategy and Facebook has grown on the back of public demand and on the back of acquisitions, because they didn't have time to develop platforms. So if someone develops a platform and they can acquire it, integrate it into their business, and use it as an enabler to grow, they will do it. So I call Facebook from passion to public business. Then there's one I'm calling from corner shop to national chain. From the corner shop to national chain. And from the corner shop to national chain, 2 companies that I looked at critically. One of them is our own local company called Melcom, and how the founder and CEO grew it using prudent approach, died during the COVID era, son-in-law takes over, and now you can see how he's been able to expand Melcom into a brand that all of us should be proud of. And then the other one is Walmart, the US company, the US multi-chain company, started through the inspiration of Sam Walton's wife. Today is the biggest employer in the world, biggest private sector employer in the world is Walmart. These 2 companies have been driven by huge level of stability. One founder, CEO, consistently been there over time, and also on the back of the middle class who want a convenient place to go and shop. Then I call one category from national business to international business. And the 2 companies that I want to highlight here is UBA, the UBA Bank, and EcoBank, UBA Bank and EcoBank. I'll talk about EcoBank again in further slides. But these are entities that started in one country that has expanded into multiple countries across the African continent and beyond. So from national business to international business. And the 6th one, I call it from sustainable business to a national asset. Today, MTN is a national asset in Ghana, national asset in Ghana. So let MTN Momo platform go down for 1 hour. Let MTN data platform go down for 30 minutes. It's a big issue in Ghana here. So I call them sustainable business. And remember, MTN started with only $20,000. MTN, you see there, started with only $20,000. Today is 11.5 billion Ghana cedi company, as you see it. And the valuation is in excess of 50 billion, as we see it, from just 25,000 Ghana cedis. MTN is a huge national asset. If you go to India, you come across two companies, two huge companies. One is Reliance, which is run by a guy, founded by a man called Ambani, whose son got married 2 weeks ago. And Ambani spent close to $600 million, not Ghana cedis, $600 million in getting the last son of Ambani, the founder of Reliance, marry his long-term sweetheart. And then the other one is Tata. And it's a huge business in India. The thing about Tata is a national asset because Tata is the only company in the world, that gives 60% of its returns to charity. Tata is the only company in the world that is owned by a foundation set up by the first generation CEO of Tata. 60% of all returns that is made by Tata doesn't go to the shareholders or the investors. It goes to charity. And it's the only company in the world that does that. Tata is a national asset, is a national pride of India. And then there's one I call from international business to a global icon of influence. From international business to a global icon of influence. And that is the case of Taiwan Semiconductor Manufacturing Company. 53% of all devices in the world carry a chip that is manufactured by this company in Taiwan. If supply chain impacts this company in Taiwan, the whole ecosystem and supply chain for the technology market will be at huge risk. So from Jumia to Mary Kay to Facebook to Multimedia Group to Melcom to Walmart to EcoBank to MTN to Reliance Tata to Taiwan Semiconductor Company, studying them, going through their financials, trying to understand the thinking of the founders, the thinking of the CEOs has brought us to this point where I think that growth is deliberate. Every company can grow. There are things you can do to grow, and there are habits you must put into your company to be able to grow. And of my going through 109, it's more than maybe in excess of 109 different companies that I've looked at. I've come to the conclusion that growth indeed does matter. So the question here, and put it in the chat box quickly, your thought, why do you think growth matters? Why do you think growth matters? Put some thoughts in there and let me read them quickly. Any thought that comes to mind, why you think growth is very, very important, and organizations must discuss growth. Companies must put growth on the agenda for meetings. Why do companies have to grow? Why does growth matter? Put some thoughts in the chat box. How do I get this chat again open? Let's open. Please put your thoughts in there. Why do you think growth matters? Why do you think growth matters? Why do you think growth matters? I'm waiting for some thoughts. Why do you think growth matters? Why is growth important? Why do we have to discuss growth? Why should companies be discussing growth? Why? Okay. Somebody is selling Mary Kay products. So please, whoever is selling Mary Kay products, if you allow us, we'll put your number or your name out there so people can contact you so that we can buy Mary Kay. You've been a consultant for over 10 years. Okay. It's one of the companies that I've studied. Growth is very important because the going concern of the business depends on it. That's true. If we are not growing, then we are not dying. We are dying. Someone says growth will ensure sustainability of business. Kojo says that. That's very true. Growth is the basis for sustainability. It's an Infinix Note 10. And those whoever is using Infinix, one of the companies that I studied is also Techno. Techno's high-end product is Infinix. That's true. Root says growth will boost revenue. That's very true. For future sustainability, we have to grow. We have to grow to meet new demands and stay relevant. That's very true. That's very true. To meet new demands and stay relevant. That's very true. That's why we have to grow. Good. So let me give you the 7. So everything you have said is right. I'm just summarizing it into 7 very potent points for you why growth matters so much. Growth matters so much. The first is that growth is what drives performance. Growth is what drives performance. So growth is critical in any organization because it is the only way that people will perform. Only way people will perform. Number 2, the culture of an organization is driven by growth. You see it. You walk into an organization that is not growing and you see it. It's clear. The habits, the behavior, how the organization is organized and all of that, you see it. So if you want to identify a growth-oriented company as against a fixed mentality company or a company that is innate for being innate, you can see it through their culture. So culture, growth drives culture. Number 3 is that growth drives employee satisfaction. Everybody wants to work in an organization that is growing so they can also personally grow. Human beings desire growth. Of the 5 things that human beings desire, one of them is growth. Human beings they have a desire for growth. They have a need for growth. They have a need for significance. And significance and growth drives employee satisfaction. That is why when people remain in their position for so long and they are not being promoted, they leave. They leave and go and look for a job somewhere, because if the company is not expanding, it's not extending, and it's not growing, then opportunities for them to get to the top is also limited. So growth drives employee satisfaction. Growth drives shareholder satisfaction. Shareholders are happy with managers of a business, leaders of a business, as long as the business is growing. They get excited with that. They are happy to put more money in the business. They are happy to back and support initiatives of managers and leaders because they are on the right path to growth. So growth matters because growth drives shareholder satisfaction. Then growth attracts capital. Growth attracts capital. Capital is neutral. I'm going to say it somewhere along the line as I move along, that capital is neutral. So capital will go to a place where there is growth. Once an organization is growing, it's able to attract capital, but not only attract capital, you attract capital at low costs. The cost of attracting capital is very low. So Apple, for example, has close to 72 billion cash and cash equivalent of 72 billion. But Apple will go and borrow 22 billion. Banks will come to Apple and offer Apple an interest rate of 0.025% to give them 20 billion to pay shareholder dividends. Why? Because Apple is a growing business. And because it's a growing business, it is able to attract capital. There's the company that is at the forefront of delivering chips for artificial intelligence chips. It's called NVIDIA. That company is raising huge amount of cash in immeasurable proportions. The cash that they are attracting is in immeasurable proportions. Why? Because investors and shareholders have seen that the next pathway for growth is through this artificial intelligence, and the chips that they manufacture for devices upon which artificial intelligence is going to ride on is being manufactured by this company. So when you grow, you attract capital. People come to you and want to associate with you and want to buy. That is why when MTN had this IPO, it was oversubscribed, significantly oversubscribed. Then growth attracts and retains best talents. Remember, growth drives employee satisfaction. So employees become satisfied because the organization is growing. But growth also attracts and retains the best talent. So you realize that organizations that are doing very, very well, hardly do the people leave. Hardly do the people leave. And I'm going to talk about EcoBank, for example. And I'll show you that the rate at which people desire to work at EcoBank, or people are unwilling to leave, is because they see growth in that environment. So growth attracts and growth retains best talent. And then finally, growth attracts opportunities and unleashes growth. So to grow, you must grow. And once you grow more and grow more and grow more. Just imagine that iPhone made a first annual revenue of 12 million, a first annual revenue of 12 million. Okay. And then you realize that 15 years later, that revenue has moved from 12 million per annum to in excess of 123 billion per annum, from 12 million. Why? Because once you begin to grow, it attracts other opportunities for growth, and it unleashes growth, and it unleashes growth, and it attracts opportunities. So why does growth matter? Because it drives performance, because it drives culture, because it drives employee satisfaction, because it drives shareholder satisfaction, because it attracts capital, because it attracts and retains best talent, and because it attracts opportunities and unleashes growth. That is why growth is such a very important thing that we must talk about. But there are three angles to growth, three angles. There is one that I call bad growth, and I'll explain what bad growth is. There's one I call disguised growth, and there's one I call good growth. What should a company pursue? A company must always be pursuing good growth, because there are some growth which is disguised. So when you have when you win a tournament, I use the explanation of a tournament. When you win a tournament, you have delivered some level of growth, but it may be disguised because certain other factors went in your favor. You pulled out, I remember when Usain Bolt in the 100 meters in the Olympics, jumped the gun. Everybody expects Usain to win the 100 meters and probably set a new world record. But he jumped the gun. I mean, after 4 years of preparation, he got on his marks. They say get set, and before the gun was fired, he was up. The rule says you must be disqualified. But somebody won the race. Johan Blake, somebody won the race. But it doesn't make Johan Blake the champion. His growth and his success and having the gold around his neck was not because it is sustainable or it is good. It's because something else happened that made it possible for him to win. So there are growth like that. And a huge opportunity will come, and a company that is making revenue of 10 million makes revenue of 200 million in 1 year. And people become excited. The source of that growth is not one that I'm going to define as sustainable. It's one that is one-off. It's a hit. One hit happens. Sometimes this guy's growth comes in the form of productivity improvements. So we want to cut down. So our profit is 10,000. We let 50 people leave the organization. The 50 people save us 30,000 Ghana cedis in payroll costs, and our profit all moves from 50,000 to 80,000. Yes, bottom line has gone up. But what is the source of that growth? Okay, so growth can come in a disguised manner. That is not a growth that we want to pursue. It is one-off. We did it either to improve our top line, improve our bottom line, improve our cash flow, but it is not. It is disguised. It is in disguise form. Then we have one that is bad growth, and I'm going to explain that. And we have one which is good growth. And our emphasis will be on how do we deliver good growth? How do we get growth into the business? that is good. So look at these entities. I'm showing you 4 entities. One is Swiss. Swiss in its prime was top in Europe. In its prime was top in Europe. One of the companies that, like Jumia, accelerated its growth is Beige Capital, which turned out to be Beige Bank. And then on the right-hand corner, top right-hand corner, I have shown Gateway Broadcasting Services. Gateway Broadcasting Services is the company that came and basically wiped DSTV off the market, but it lasted for only 14 months, only 14 months. But the revenues that they showed in that 14 months was amazing. And then on the right bottom corner, you see UT Bank, a bank that grew outside its core. So we'll talk about that. Why some growth is good and some growth is bad. And just to take off here, growth that is from the core is good. So we have UT Services, we have UT Real Estate, we have UT Car Sales. You have lots of UT things, lots of UT things. And they were growing, but was it good growth? Was it bad growth? As we move along, we will see. Then I'm showing you another one. And on the left-hand corner, you obviously see MTN Momo. You see Muhammad Enterprises Tanzania Limited. It's a company in Tanzania. In 2022, they sold 1 million bottles of soft drinks. Never happened before. On the left-hand side, you see Reliance, the big company that is owned by Ambani in India. You see Tata, the huge national asset that is owned by Ratan Tata. You see Melcom, our own Melcom, and then you see Dangote in Nigeria. So what do I call all of this? I categorize all of these people who grew their growth, as I will explain further, bad growth. Then I categorize the other group as good growth. So let me give you the 5 pointers of bad growth. Number 1 is mergers and acquisitions. Mergers and acquisitions that is intended to deliver 1 + 1 = 3 is fundamentally flawed. All of the 109 entities that I studied, of the 109 entities that I've studied, I've not said that 35 of them have ever been in mergers and acquisitions. 35 of them have ever been in mergers and acquisitions. The ones that have seen significant growth in their mergers and acquisitions have seen significant growth because they acquire for competencies, for capabilities, and for market share. And I'll give you 2 examples here. I'll give you 2 examples of why mergers and acquisitions intended to deliver 1 + 1 = 3 never happens. When you take Capital Bank, I'm sure most of you know Capital Bank, and you take UT Bank, and you take Ghana Commercial Bank, and you put these 3 banks together, at the time the 3 banks consolidated, and today, they are delivering 83% of what the consolidated entity was when they consolidated. So between Ghana Commercial Bank, UT Bank, and the Capital Bank, when Ghana Commercial Bank absorbed UT Bank and Capital Bank, the top line revenue and the bottom line revenue they are delivering 3 years after is less 17% of what the combined bank was when they got together. Then, when EcoBank bought Trust Bank, for those of you who don't know, EcoBank bought Trust Bank. Okay, EcoBank bought Trust Bank, I think in 2011, if my memory serves me right. In 2011, for 220 million Ghana cedis at that time, close to $130 million at the time when EcoBank bought Trust Bank. Now, EcoBank, the man was running EcoBank, Mr. Ape, APKE, should be able to pronounce it better, had a clear growth agenda. And EcoBank was categorized as an elite bank. Trust Bank was more into the middle markets because Trust Bank was owned by SNIT. So most people, most employees and people who were affiliated to SNIT and other people who were in the middle class had accounts with Trust Bank. Now, EcoBank's strategy is, how do we get into the space that we don't have the competencies and the capabilities to attract people from? Look around, identified one entity that is doing very well, not in the top tier, but in the middle tier. If we absorb this company, we'll be able to move faster, grow well, sustainably, than we trying to do it from scratch. So they spent $220 million to buy Trust Bank. And as I move along, I'll tell you that today, EcoBank delivers over $5 billion in revenue. Ghana Commercial Bank has more assets than EcoBank. They deliver in excess of $3 billion in revenue. EcoBank delivers in excess of $5 billion in revenue. Since the acquisition in 2011, what are some of the things that EcoBank has done to give true meaning to the fact that we buy only for competencies, capabilities, and markets? I'll give you another example. Fidelity Bank. Fidelity Bank bought an organization called ProCredit. For some of you, if you remember, in 2014, Fidelity Bank bought ProCredit. At the time, ProCredit expertise was in serving small, medium, and micro enterprises. ProCredit expertise. Fidelity had just emerged as an investment bank into the full-scale universal banking arena. Now they were looking for an opportunity to be in the top 7 in Ghana. From zero, how do we get into the top 7? Oh, there's a bank, there's a small savings and loans company that is very good in the informal sector. They are excellent in small, medium, and micro enterprises. They have 400, at the time 325 agencies across. So if you look at the banking space today, Fidelity has more agencies, small, you see them, the kiosks, they call them Fidelity agencies. It's the learnings from ProCredit. So Fidelity now goes and buys ProCredit. Now that acquisition of ProCredit is not to deliver 1 + 1 = 3. It's to deliver a certain understanding of a certain space that will take them 50 years to learn. But in bringing that acquisition, that entity into our fold, what will take us 50 years to learn, we learn it in 5 days. And that is what Fidelity does. So mergers and acquisitions are good. I'm not saying they are not good, but mergers and acquisitions intended to drive revenue to be big, growth and all of that does not happen. What really helps in mergers and acquisition is when you are engaged in mergers and acquisition for purposes of driving your capabilities, improving your competencies, and getting into a certain market space that it will take you many years to get into. So bad growth, one of them is mergers and acquisitions. Another that I want to talk about is price cuts. Sometimes organizations cut prices in order to gain market share. Sometimes it is not influenced by efficiencies in operations, processes, and costs. So they cut some prices, and the airline industry can do that. So sometimes they undercut each other in order to get numbers in. And that strategy can be very bad for growth. Then you have the inefficient use of capital. I mean, you are putting capital in a business that does not deliver you a return of risk-free plus a premium. If it's not delivering a return of risk-free plus a premium over a period of time, not one time, over a period of time, then we'll call that inefficient use of capital. And sometimes you offer customers favorable terms because you have some big customer. And this big customer says, I will bring you this. It's like when the tier 3 companies, the savings and loans companies, the microfinance company. That is why a lot of them have died. They have collapsed. They are dead. So companies like NDK, Ideal Finance, you know them, a lot of them, they have died. Why have they died? Because they go to people and tell them that, give me the money. I'll give you 10% a month, 5% a month, 6% a month, and all of that in returns. And then what they invest the money in does not bring in the returns to be able to compensate for the promises that they have made. So a lot of them have died. And most of them, if you look at their numbers, they grew. I mean, the growth rate was amazing. But where are they today? Favorable terms to customers is sometimes not the best. Then top line growth with not corresponding returns in profit and cash flows. Top line. Anytime you are growing, but to grow, you have to put in place a credit control structure, infrastructure. It is bad growth. Growth that increases receivables is bad growth. Growth that demands that you set up another layer to be able to change your cash, to chase your cash, is bad growth. So avoid that. Avoid that because it is bad growth and it is going to hurt your business in a serious way. And this is good growth. This is good growth. All these people are growing very well. Why are they growing very well? Because they are growing organically. Organic growth is good growth. Profitable growth. And listen, look at what I've said here. Growth that improves gross profit, not net profit. Growth that improves gross profit is what we call good growth. Growth that improves gross profit. Growth that improves net profit may be disguised growth or may sometimes be even bad growth. So if you are trying to determine and find out where your growth is coming from, look at how your gross profit is performing. If your gross profit is going up, then it is good growth. Good growth must be driven by your gross profit. Good growth is cash flow driven. If your top line is going up, but you don't have the cash, there is something wrong with your business. Top line growing, revenue growing, but you are still stressed, struggling to raise cash to pay your bills as and when they fall due. You can't pay salaries on time, even though you are growing. It is bad growth. Look at it again. Good growth is in differentiated products and it's in services. Good growth is growth that comes about as a result of differentiated products and services. That does two things. It meets new needs as well as unmet needs. In other words, it offers unique customer experience. If your growth is as a result of the customer paying you more, and I'm going to talk about the customer as one of the ways of unlocking growth. Customer paying you more for the service that you are offering from the same customer, it is good growth. We said bad growth is inefficient use of capital. So it means that efficient use of capital is good growth. Growth that is internally funded is good. Internally funded. So it means that you have grown, you have the cash, and you are using it to fund your growth and your expansion and your new pipeline. It is good growth. Good growth is sustainable, and I'm going to define what is sustainable for you today. Good growth is sustainable in revenue, sustainable in profit, and sustainable in cash flows. So it is a marathon. You must see it consistently over time, not one-off. And good growth finally enhances shareholder value. It enhances shareholder value. So good growth has 7 critical parameters. Bad growth has 5. Disguise has 2. And I've shown you all 2 disguise, 5 bad growth, and 7 good growth. So the question is, do you know the growth potential in your organization? And sometimes if we have a part 2, to growth. The part 2 part, which I will do, is to look at how you will be able to calculate growth. There's a way of determining the extent to which your business can grow. There's a scientific way of determining it, an accounting and a finance way of calculating how your business can grow. So I'll answer that question then, what is the growth potential in your industry? There's a way by which we can determine the extent to which an industry can grow. There's a way by which we can determine the extent to which your organization can grow. There's a way by which we can determine the gap between where you are and your potential. There's an accounting and finance way of calculating that. And sometime in one of the webinars, I will take you through that. But now let me define what is growth. What is growth? So we've talked about growth. The question is, what is growth? How do we define growth? Growth is defined as the consistent increase. So it must be consistent increase in the value of an enterprise and a business. Observe over a period of time, and I'll talk about the period, but I'll answer the period. But here, let me tell you that the period is 7 years. In identifying whether a business is growing and growing well, we do a trend analysis for at least 7 years to be able to determine that, okay? And it is usually driven from its core of revenues, and margins. Its core of revenues and margins. And it is arising from a capture of a disproportionate share of the market or the creation of a new market. And growth must happen through a process of innovative actions. So I have underlined, very important to note, I have underlined 1, 2, 3, 4, 5, 6 very, very important, 6 very, very, very important elements in the definition of growth. So what is growth? It is consistent increase. So it must be consistent. It's not one-off. It is happening every year. You can see it. And it must be consistent over a period of time. Have we defined the time? Yes. What is the time? 7 years. But a 5-year trend may be an indicator. But best 7. You can use 5 years to determine, but to be firm and sure, 7 years. Where does it come? It comes from its core of revenues and margins. What margins are we referring here? Note it is gross margins, not net margins. Gross profit, not net profit. Because net profit is a factor of many things like depreciation. Depreciation is driven by a policy. I can use depreciation to be profitable. If you do anything to use inventory to massage your profit, we can see in your GP. And it arises from a disproportionate share. So in the last 5 years, for example, the banking sector, in terms of deposits, has been growing at the rate of about 32%. EcoBank is growing at 38%. So they are growing higher than the market average. So it means that they are capturing a disproportionate share of the market, And it comes from 2 things. Either you are creating new markets or it's as a result of innovative actions. So growth must be driven by innovative actions or from the creation of new markets. That is what we define as growth. What is sustainable? I've used the word already, 7 years, but I'm defining here for you to see what sustainable means. Sustainability means growth from creating and replenishing a pipeline of initiatives. It means that you are doing something every year. That is why iPhone is coming to the market every year. They are replenishing its initiative every year. and every year they will add something. They'll make it either small, sleek. They will add something to camera. They will change the what do you call it? The storage. They always do something. Always doing something. You know, organizations that are innovative. What are they doing? The other day, we're traveling. In fact, it was started by Etihad. Etihad started providing internet 32,000 feet above sea level. 32,000 feet above sea level. Now every airline is doing it. So we're coming from India the other day, and we're enjoying ourselves. We're having data on Ethiopia because everyone is doing it. So what are the things that you are doing to engage your business class customers? What is the new thing that Mercedes-Benz is doing? What is the new thing that Rolls-Royce is doing? How do you replenish so that every day people are looking for your product? Once you are able to do that, then we can call that sustainable. And it must be looked at over a period of 7 years. You can do 5 years. 5 to 7 is fine. 5, it's a good base, but 7 is firm and quite sure. Why do you think a growing business will fail? Get into the chat box and put some comments there. Why do you think a growing business will fail? Why will a growing business fail? The company is growing. Yes, it's failed. Why will a growing business fail? Okay, let's have some thoughts. Any thoughts? Any thoughts? Share some thoughts in the box. I'll read it. Why will a growing business fail? The business is growing, yet it is failing. Why do you think a growing business? Complacency, super point there. Complacency, yeah, complacency. If the growth is not organic, you are right. If the growth is not organic, and you don't put in the right structures, you are bound to fail. You are right. You are right. Complacency. Any other thoughts? Any other thoughts? Why a growing business will fail? Why a growing business will fail? What reasons account? Lack of innovation. That's very correct. Lack of innovation. Innovation is at the core of growth. When you refuse to innovate, you are likely going to paying less attention to innovation. Lack of planning. Instead of saying lack of planning, just put it lack of long-term planning. Long-term planning, because growth is a marathon. So lack of long-term planning, you are likely to fail. Failure to research market. That's very correct. Instead of failure to research market, we change that. I put it in the right field for you, and it's failure to understand the market. Lack of understanding the market. It's not researching the market, but not understanding the market. Not understanding where your next customer is going to come from. 40% of Africans' population below the age of 35. In fact, globally, it is said that by 2030, globally, 40% of everyone on earth will be below the age of 40. So if we are a company looking beyond 2025, what should you put in place now to ensure that you capture this market? That is understanding the market. Yes, failure to understand customer needs, correct? Failure to understand. Getting hit by unexpected events. The good news is that unexpected events should not cause your company not to grow, because we are going to talk about the 7 things, 21 things, but I'll share 7 here today. 7 things that growing companies have. And one of them, we'll talk about it, will address the issue of things like COVID, hittiness, and hittiness. Being oblivious about your mistakes, correct? And not learning from. Super point there, poor leadership. Now, instead of poor leadership, I'm going to use a word for you. There are 3 categories of leaders that I'll talk about shortly. Paying less attention to employees' needs. Paying less attention to employees. It's not paying less attention, but when you don't align, So I don't like using the word attention to employees' needs. It is lack of alignment between employee purpose and professional intent and the organization's purpose and professional intent. And that is what creates the issue. It is not the attention. but it is the lack of alignment. The employee is thinking about something. You're also thinking about something. The employee is looking for certain things. How do we align the two? So it's a lack of alignment. And I like that point there, lack of talent acquisition and retention. Talent, how do we get the right people in, and then retention. I'm not too sure I have the time, and I've told you the story of Taj Mahal, but let's see how it's go. I like the next point, poor management. Poor management. Instead of poor management, it's poor leadership. Poor leadership. Because managers are not in the business of looking for the next big thing. Managers are in the business of preserving and managing. The people who are in the business of exploring and looking for the next big thing are leaders. So very, very solid points there. All your points are very valid. Very, very solid. Very, very solid points there. Critical signs of potential failure. We talked about them. Critical signs of potential failure of a growing business. Let me give you 3. One is lack of cash. When a business doesn't have cash, it's a sign of potential failure. Sign of potential failure. Declining gross margins. Declining gross margins is a sign of potential failure. It's a sign of potential failure. Weak asset turnover. Weak asset turnover is also a sign of potential failure. And the fourth one I'll give you is what we call poor leverage. Poor leverage. If the mix of equity and debt is not properly structured, it can impact significantly your business. We call it leverage. At some point in time, we'll discuss it in some other webinar. What should the business manager focus on? Focus on sustainable growth in revenues, consistent improvements in profits, using the right level of capital and resources, ensuring that your business is growing organically, and creating new and unmet needs and open market. This is the way to sustain the growth. This is the way. 5 ways of sustaining growth. One is focus on growth areas that are sustainable. So that will grow. That will grow. That is why Apple has a future. Why does Apple have a future? Because 65% of Apple customers or 65% of iPhone customers are below the age of 45. Below the age of 45. So if they have another 25 to live on Earth, they are already Apple loyalists. They will continue to be Apple loyalists. Consistent, sustainable improvement in profit. It's a marathon. It's not a hit. It's not a tournament. It's a league. League means you are playing 38 matches over a period of 8 months. Consistency. Small, small. Don't look for big hits. Small, small. You go up by 2% in a quarter. You go up by another 3% in another quarter. You maintain your 3% in the third quarter. By the time you realize you have gone up by 10%. Small, small. Utilization of capital. Where do you put your capital? The capital that you have, the resources that you have, how are you utilizing it? And then always grow from the core, organic. Organic is very important. Adjacencies, extensions, all organic, all organic. So in the past, we had Ideal Milk. When you buy one, the family uses it, puts it in the fridge. Now you have sachet. Is it sachet you call it? Now you have sachet. You know, Key soap used to be long. Now it is small. So they've seen that some of their consumers that they are targeting, they can't buy the long one. It is expensive. So you cut it small, you sell to them. What are you doing? You are growing through extensions, product extensions. And then you create new and unmet needs and open up the market. That is why I like multimedia. Multimedia Group has Multi-TV. It's one of the companies that I mentioned. Multi-TV, that is the first free-to-air satellite, what we call direct-to-home satellite broadcasting in Africa, the first of its kind. And Multi-TV now is leading in the television space. in the television space. Attributes of good growth, I summarize that again. Good growth must be profitable. I have a company each there. The most profitable company in the world is Aramco. It's the Saudi Arabia oil company. It is called Aramco. It's the most profitable company in the world. The most organic driven organization in the world, I call it Alphabet. You all know it at Google. The most differentiated company in the world is Apple. And the most sustainable entity that you can see in the world is Berkshire Hathaway, the company of, what's the guy's name? Warren Buffett. Warren Buffett's company. So these are attributes of good growth. An organization grows great when its leaders plant trees in whose shade they shall never sit. Okay, so it means investment is a reflection of growth. Let me end by giving you the 7 conditions for unlocking growth. I have 21 of them. I'm going to share 7 with you this morning. Seven with you this morning. The first condition for unlocking growth is the leader's ambition. The leader's ambition. Somebody talked about leadership. Why companies don't grow. Any company that has grown on the back of the leader's ambition. If the leader, the CEO, the managing director of the company, the general manager of the company is not ambitious, the company will never grow. Growth is a reflection of the leader's ambition. So when companies stagnate, is the leader. And I'll show you 3 categories of people. Ambition is the light that unleashes dreams, shapes perspectives, and inspires action. Never forget that. Okay? There are 3 categories of leaders. 2 of them never grow a business. In fact, the first category is a leader who I categorize as a squatter. Squatters move businesses into decline. They move businesses into decline. Then we have the settlers. Settlers stagnate a business. If your leader is a settler, your business will not grow. If your leader is a squatter, nothing new will happen. You see the business going backwards. You see that when you go to an organization and they say, when we were we, leadership are squatters. Then we have the third category of leaders who are ambitious. We call them the smart, very ambitious leaders. These are people who go on a leadership journey for 3 things: for personal reasons, for professional, and for profits. So smart leaders personally want to be big and want their organizations to be big. They see huge things. They see vision that most people don't see. It's personal. Then they translate it into their professional life. Then when they are given organizations to run, they run the organizations in a profitable manner. Now, smart leaders who are ambitious are also curious, and they have the courage to make bold moves and take risks. I'm going to tell you about 4 people, 4 CEOs that I've studied. They have the perspective of long-term thinking. They are knowledgeable and they have an innovative mindset. Their personal choices in resource allocation is on point. Anything that they put money to must deliver a return. And the return must be higher than the risk-free plus the premium. And I'll tell you about 4 people. 4 people. The first one you see there is a man called Roberto Gozziata. Roberto Gozziata is a Cuban who migrated to the United States of America, had an opportunity with a company called Coca-Cola, and became the CEO of Coca-Cola, running the company for over a decade. Roberto Gozziata is the one who called the staff one day and told them that from today, Coca-Cola will be selling 1 bottle a day in China. The Chinese population at the time he was speaking was 1.1 billion. Roberto Gozziata's ambition was to sell a bottle of Coke to a citizen of China each day. That is selling 1.1 billion bottles of Coke. Roberto Gozziata moved the revenue of Coca-Cola from a little below 20 billion to 29 billion US dollars. When your leader is ambitious, your company expands in unimaginable proportion. The next man I want to talk to you about is a man called Ahmed Farouk. Ahmed Farouk was for 9 years the CEO of MTN Ghana. MTN Ghana. Ahmed Farouk became the CEO of MTN Ghana when it was Space Phone. From Space Phone, he moved it to Ariba. He was still the CEO. And from Ariba, MTN bought it. Ahmed Farouk was the CEO. If the telecommunication industry in Ghana has seen significant growth, I attribute it to the man called Ahmed Farouk. The things he did to create the foundation that today MTN controls 93% of Momo in Ghana, 65% of all voice calls in Ghana, 78% of all data in Ghana is because of the foundation that Ahmed Farouk put in place. He invested and invested rightly. I'll talk about investment shortly, but he invested and invested rightly. Then I tell you a man called Ferran Comte. Ferran Comte is the CEO of a club, a football club, and the football club is called Manchester City. Manchester City. He became the CEO of Manchester City in 2012. And set up an ambitious target of winning 5 Premier League titles in the next decade. Target. He wanted to win 5 Premier League titles in the next decade. As at that time, Manchester United had won close to 25 trophies. Manchester City had won 2 in their previous life and had not won again for over 40 years. This guy from Spain, this guy is Spanish, became the CEO of Manchester City and set a growth ambition of winning 5 Premier League titles in 10 years. The result is that he has won 7 Premier League titles in 10 years. 7. His target was 5. Never happened in the history of Manchester City. For 10 years that Ferran Comte has been at Manchester City, he has won 7 Premier League titles in 10 years. That is what growth leaders bring to the table. When your leader is ambitious, the company will grow. To unlock growth in your company, first, put in a growth leader and things will change. As for Alexander the Great, everyone knows the story of the young man called Alexander the Great. He became king at 20, died at 30. In the 20 years that he was king, he did 7 times. He did more than his father, who had been king, couldn't do in so many years. Alexander the King, the Great, was one guy who conquered countries, brought many countries together, not only in Asia, not only in Europe, but also in Africa. Between Africa, Europe, and Asia, Alexander the Great conquered more countries, unified more countries, brought more countries together than any other person has done in life for a short period of 10 years, from 20 to 30. If your organization is to grow, you need an ambitious leader, one who is smart. I pity you if your leader is a settler or if your leader is a squatter. Nothing is going to happen. The second is the environment. The environment, and I'm going to run quickly because we are over time. The second is the environment. The environment that the organization creates is an enabler of growth. What environment is your organization creating? What does the organization focus on? When you have meetings, what do you discuss? You have to look at all of that. How is your structure like? Is it lean and flat? Where does decision-making happen? And I'll tell you about the company called Southwest when I move on to something. Note that for me. I'll tell you about Southwest shortly. What is the speed of execution? What is our culture? Is our culture one of sprint or our culture is one of marathon? What does our culture promote? The environment is a big enabler of growth. If we want to grow, we have to develop a growth-oriented environment and make sure that everybody is on the same page, we speak the same language, and nothing is hidden from anybody. In a growth-oriented organization, there is not them and us. There is no us and them. There is no the managers and us. We are all together as one. The third thing that can be used to unlock growth in your business is investments. Investments. What nature of investments are you making as a business? The investments that Ahmed Farouk made at MTN, including the business development investment, the marketing investment. You know, at the time, the leading mobile service provider was Millicom, Mobitel. Then Space Fund gets into the market. And as Space Fund got into the market, they were looking for an opportunity to win in the market space. Who did they target? They targeted people below the age of 30. How did Ahmed Farouk do that? Ahmed Farouk did it by building a bond with the young in the society. How did he do that? He started doing things that the young can appreciate and can associate with. His marketing was all driven by big events. Ahmed Farouk brought people like artists like Boys to Men to Ghana. Shaggy came to Ghana. MTN brought Shaggy to Ghana. They brought Boys to Men to Ghana. I mean, the things that they did created a bond between MTN and the young, those who were just leaving the university. Now, everybody was looking for 024. And to add to that, they invested in a GSM platform. When everybody was investing in analog platforms, Ahmed Farouk, Space Phone, started by investing in a GSM platform. And that made a huge difference. Now, when somebody calls you, you see who is calling you. Before then, Mobitel were in existence. What do you call it? Kasapa, Sertel, they were there, but they were all analog. But Space Phone invested in GSM platform. What investments are you making? What nature of investment are you making? What time are you making the investment? What returns are you getting? My analysis indicates that it takes at least 3 years for investment to mature and to deliver sustainable returns. So whatever you want to do next year, you must have invested now. You can't invest next year and be expecting to get the returns from next year. It is not possible. Investment accelerates growth, unleashes opportunities, and improves productivity. That is the third thing. Number 4, I've talked about it many times, technology and your digital choices. What sort of technology do you have in your business? Technology is a huge enabler because with technology, you can learn faster, you can execute quicker, you can scale smarter, you can deploy timely, you can serve your customers better, you have a competitive edge, and you grow sustainably. Technology is the 4th enabler. And when technology is coherent means that you put in a technology that everyone in the organization can use. Everyone should be able to use it so that you can make informed decisions across. So you don't deploy one for HR, one for finance, one for operations. You deploy a coherent technology platform. Number 5, partnerships and collaborations. Partnership and collaborations. Microsoft is Microsoft because they collaborate with a lot of small and medium developers. So is Meta, small. So is Google, small and medium developers across the world. And what they do, once they find some platform or some software or some service good, they bring it into their fold. The question is, what sort of partnership and collaborations do you have? I have a factory here. This is a factory that is delivering an Airbus. This is an Airbus 320 that is being manufactured by Airbus. To manufacture this Airbus needs 4 million parts, 12,500 employees to put this together. How do you get 12 million parts, 4 million parts brought in from different countries across 36 countries? 36 countries. They must all come at the same time to be able to deliver one Airbus to Ghana Airways. Partnerships and collaborations must be in place to drive growth. Growth comes from customers. Look, the best way of unleashing growth is using your customers, your existing customers. Once you are innovative, you can cross-sell. What is cross-selling? Making sure that the customer who needs water also probably had fruit juice to drink. You know, it is cross-selling that made Roberto Gozziata go and buy Columbia Pictures. Columbia Pictures is a movie house. Why did Coca-Cola buy Columbia Pictures? Because they thought that when you go into a cinema, you buy a Coke to drink. And so instead of us just being the Coke providers, let's own the platform that shows the movies. So, and the movies itself. So they bought Columbia Pictures. And 6 years later, they realized that that was a wrong acquisition and they sold it. We have something we call cross-selling. And then we have something we call social engine. Social engine is how you are able to turn over things as quickly as possible. Our turnaround time. Your turnaround time in meeting customers' needs. We call it the social engine. So I was telling you that the average airplane stays on the tarmac for 48 minutes, average, globally, 48 minutes. So when a plane lands, from when the passengers get off, the plane is cleaned, new passengers get in, and the plane takes off. The average time is about 48 minutes. It can be 2 hours, 2.5 hours, but the average globally from research is 48 minutes. Southwest Airlines said they were going to do it in 20 minutes, 20 minutes, 20 minutes. Today, Southwest Airlines is turning over a plane in 18 minutes, 18 minutes. So when a Southwest Airline plane lands, passengers get off, they clean the plane, new passengers get on, it takes them an average of 18 minutes. Now, how is a company able to do in 18 minutes what it takes an average of 48 minutes to do? It is through something we call your social engine. Your social engine. What is social engine? It is how you get all the units in the organization to come together to do what is needed. A couple of days ago, I was privileged to be at the Mahindra factory in India. Before then, I had gone to the Audi factory in Barcelona. Audi factory in Barcelona. At the Audi factory in Barcelona, an Audi comes out every 3 minutes. Every 3 minutes, you stand at the end of the production, a new Audi comes off the scale every 3 minutes. Now, the question is, how do the various units in the organization, including spraying, including engine, including the doors, including the system, all of them work together to ensure that every 3 minutes, a plane is coming out, an Audi is coming out. In Mahindra, we realize that it's about 2 minutes, 2 minutes and some few seconds. A new tractor comes out. To enable that to happen, you need your social engine, getting all the various units in the organization to work together to please your customers. Your customers are a very good source for unlocking growth in your business. And of course, the customer experience that you give them. And then finally, number 7, I call it the brand capital. The brand capital, brand capital. What is the capital of your brand? Is your brand an attractive brand or it's not an attractive brand? And a brand is influenced by the three critical people that you need in your business. Your business needs an audience. Those who are not consumers, they are not employees, they are not investors, but they are outsiders who have a view of your business. We call them the audience. Then we have the consumers, and then we have your investors. Three categories of people. Okay. Now, the brand capital is what gives you the competitive differentiation. Why would somebody want to bank with an EcoBank instead of banking with an FBN bank? Why would somebody want to be an ABSA customer instead of being a GT customer? Why would somebody wants to watch a TV3 instead of watching a Wazer TV? What is that competitive differentiation will bring to the table? That is what we call brand capital. And brand is the seventh most important element in unlocking growth. If you want to grow as a business, work on your brand. Make sure that the perception that your audience have is the right perception about your business. Make sure that the investor believes in the reputation of your business, and make sure that the consumer trusts the products that you offer him. If you have a trusted consumer, if you have an audience with the right perception of what your business is, and if you have an investor who is willing and able and ready to associate with your business, then your brand reputation is high. So build on your brand perception, you build on your brand reputation, and you build on your brand trust. The trust, the perception, and the reputation put together delivers what we call competitive differentiation. That is the seventh most important element in unlocking growth. As I conclude, let me say that the power of growth is in the stability of the business. Growth stabilizes a business. When a business is on a growth trajectory, the business stabilizes. Growth is what delivers sustained profitability. If a company is to have free cash flows, it must be a company on an never-ending growth journey. Businesses that have been transformed on the back of growth. And when you grow, you get to a point where you become a company of influence. And any organization that wants to grow must be a changing organization. You must not fear change at all. You must put technology at the forefront of what you do. You must be an advanced technology transformed organization. That is the only way an organization can unlock growth. A few months ago, I gave you some words, and those words still stand today. The only true measure of a company's success and a peep into its future is cash. And an enduring culture of change and growth, an enduring culture of change and growth, driven by the creativity and courage of a people to innovate today what is to be tomorrow. Those are my final words. And I think we are 22 minutes over time. I'll bring it to an end. And if there are any questions, we have some few minutes. We can take some questions, or we can take comments that you have. Any questions that you have? If you want to speak, you can raise your hand. We have just about 7 minutes. If you want to speak, you can raise your hand, or you can put your question or your comments in the chat box, and then I'll read it. So just to remind again, the 7 ways of unlocking growth in your business starts with leadership and ambitious leaders. You have to check, are your leaders squatters, are they settlers, or they are smart? It is only a smart leader that can move your business to the level that you want to move it to. So don't forget that. And the second thing you must always not forget is that the environment plays a very important role in growth. To unlock the conditions for growth in your business, make sure it is a growth-oriented environment. That is the only way you can unlock that. Number three, the investments that you make. The investments that you make. Very, very important. The investments that you make a huge difference. A huge, 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 huge difference. Huge difference. Number four, your partnerships and your collaborations. Your partnerships and your collaborations that you have in-house. Number five, your technology. The technology, unlocking technology, bringing technology into your business, all already puts you at the forefront. And technology must come in to meet specific things that you want to do for the organization. Technology must come in to meet specific things that you want to do. And then number six, your customers. Your customers are a great source of growth. The customers that you have today are a great source of growth. And then number seven, your brand capital. Your brand capital. So these are the 7 ways you can unlock growth in your business. Don't forget that some growth is disguised, some growth is bad, some growth is good. We want to focus on good growth, because good growth is what is sustainable. Good growth is what drives profit. Good growth is what brings cash flow. Good growth is what is organic, and you have to focus on that. The slides will be shared. Kojo is asking for the slides. AISWAM will share the slides, okay? So he's put something there. There's something there, please, the chat box. You register here for the webinar update. And then once you register, the slides will be sent to you. Let me say that if you have any questions or whatever, further questions, you can reach me by email at ato.sarpong@sarponggh.com. You can send me a WhatsApp on the same number, 024-4420-113, and then I'll answer. So any final comments? Let's get your final comments in the chat box. Your thoughts on our on our thinking on our webinar so far. Can leaders who are settlers be smart over time? Yes, it only takes one thing. Only takes one thing. Only takes one thing for squatters and settlers to be turned into smart. It only takes one thing to do that. Okay. Any further points? Yes. So the answer is yes. Can leaders who are settlers be smart over time? The answer is yes, they can be, but it takes certain things to do that. So maybe our next webinar will focus on something on leadership and a few more research on leadership. And once we are done, whatever we come to conclusion, we are here to share with you. We hope that it's been a good session and that we've learned one or two that we can apply into our business, our departments, whatever we can apply to it. So as I said from the beginning, this is 2 hours of research and work that we summarized in just 90 minutes. This is part 1, subject to time and all of that and my own availability. We may give you the part 2 of some of the research findings, which then becomes somehow you can even calculate growth and potential and all of that. So if there are no further comments, I don't know if Vanessa is on the line. You can close us. We are just 2 minutes to shut down. 2 minutes to shut down. So thank you, everyone. It's been good. Your comments were also insightful. It will go definitely into some other presentations elsewhere. And I'm hopeful that you'll be able to join us on our next webinar. You are all also invited. 22nd, we have a book launch. I'm launching a book on leadership. on the 22nd of August here at AH. It's a book titled Eyewitness to Leadership, Walk Through the Corridors of Leadership. So I share some thoughts on leadership and how you can be a great business and public leader. Thank you very much to everyone. We'll see you again some other time. So we can